Great, well, thank you very much. Let me welcome up our next panel, Catalyzing Capital. Okay. We've got with us today, we're very pleased to have Suzanne Buchta, who's the Managing Director of Green Bonds at Bank of America Merrill Lynch. You could come on up here. Marcene Broadwater, who is the Global Head of Climate Strategy at the I.F.C. And Poppy Allonby, who's the Managing Director of the Natural Resources team at Blackrock. Thank you so much for being with us. Thrilled today to have an all-women panel as well, talking about, as I said, sort of the official title of this panel is Catalyzing Capital, but I'm actually just going to call it the Money Panel, because that's what this is all about. We're going to be talking about sort of where has the money been going and where does it need to go? Because at COP21, of course, companies, governments, and foundations all made very significant pledges proposing new investment in research and innovation to accelerate the deployment of clean energy. And of course, there has been, as we've heard on many panels earlier today, a pretty large flow of funds already moving. But there is scope for more, especially because there are bottlenecks in certain areas. And Poppy, as the investor on this panel, maybe I could start with you. BlackRock, you've been studying this issue in depth. BlackRock also just recently kind of put out a report, taking a look at the overall situation. Let me just ask you to kind of step back and give me an assessment of, how are you seeing the landscape out there right now? Where is the smart money going, and where is it being blocked, and what needs to happen?
Sure. Well, thank you very much for having me here today. I think first of all we have to celebrate what's already been done, and I think you've heard from other panelists today about the enormous growth we've seen in the allocation of capital and the growth in particular areas, particularly renewables. And frankly, I don't think anyone here would have imagined 10 years ago just how far renewable penetration would have got, and that has clearly been facilitated by a lot of capital investment. But there's clearly more to go, and there's clearly more to do. So how can investors be part of that? And I think one of the answers is really bringing investors along that journey and helping investors understand both the risks and opportunities that climate change poses to them. And so we've been very clear at BlackRock that we think climate change is something that all investors need to consider in their investment process, and that climate change has the potential to both create lots of opportunities for investors, but also quite a lot of risk for certain parts of their portfolio. So I think you asked about bottlenecks, one of the key things that continues to need to happen is providing investors with better tools, better transparency, better reporting, so that investors can better assess those risks and opportunities. Because if we look back historically, our analysis shows at least that climate change hasn't been a big driver of asset returns in the past. But that doesn't mean that it won't be in the future. And encouragingly, we see increasing interest and questions from our clients who are interested and worried about some of these issues. The second thing from an investor perspective in terms of constraints that I'd add is that while there's a great story to be told around the adoption of technologies like solar and wind, I think it's important to be honest that there's been a huge amount of top-line growth, but that hasn't in all cases translated into bottom-line growth and profits and shareholder returns. Now, it has in some parts of the market, for sure, but not everywhere. And just to give you a sense of that, over the last 5 years, the S&P 500 is up around 70%. But if you look at the S&P Clean Energy Index, which is a proxy for some of the more greener renewable power producers, that's actually down over the period. So I think one has to be honest about that. But I think we can come to this later, but I think if you look forward, there's more reason to be optimistic than when there has in the past. And the last bottleneck that's certainly on my mind as an investor is really thinking about the future needs and where that capital needs to be. And I think when we look at the growth opportunities and where capital needs to flow, a lot of that is in developing markets, and that comes with its own challenges, but I'm not the best person on this panel to talk to that, so I'll leave that to some of my other panelists.
Well, that's actually a great opening for Marcene. Talk to us about the role that organizations like yours can play in addressing some of these challenges that Poppy just raised, in terms of where are there blockages as far as you can see, and then also particularly with respect to emerging markets, what are the challenges there, and what can an organization like yours do to kind of help leverage the situation, especially with private money?
Great. Well, thank you very much. And well, I agree with Poppy that we've come a long way. And last year we did probably about $350 billion in clean energy. There's a very long way to go. So the latest estimates are that we need to invest about $6 trillion a year in clean infrastructure over the next 15 years. And 60% of that is going to be in energy and transport. So we really need to have the discussion of going from the billions where we're at to the trillions. So I just want to frame the amount of the challenge that we have here. It's pretty big. The good news is that we see a lot of interest in financing from investors, from banks. We've had billions of dollars of pledges at the COP from the private sector in terms of investing in the green economy. We see a lot of interest. Just last May, we were an anchor investor in a green bond. We'll talk more about green bonds in a few minutes, where the bank got 62 basis points of premium, and they attributed about 40 basis points of that to the greenness of the portfolio. So I think that's a really good news. And they were 14 times oversubscribed. So there's a lot of interest there. So that's the good news. Billions of dollars, lots of interest. It's a low interest rate environment now. People are looking for yield. So again, there's opportunity here. The bad news is that I think that the low-hanging fruit has somewhat been plucked. A lot of the easier deals have been done or are being done in the big economies, et cetera. And so what we need to do is to move into the emerging markets where a lot of this is going to be generated. And of course, that has a lot of different risks. So not only is it the project risk, getting people comfortable with the technology and the projects, but it also has the country risk, the political risk, the regulatory risk, the off-taker risk. So there's a whole layer of other risks that come with moving into the economies that right now the institutional investors, the commercial investment banks are not as comfortable with. So the question for all of us here is, look, how do we move this money that we know is there, we know is interested, but how do we unlock it? And how do we help face those risks? So I think there are three areas again. One is just in general risk mitigation. So at I.F.C, we are working with donors such as the climate investment funds, the Canadians, to blend donor financing, which is can help address some of these risks at lower prices with our market-based financing. So for example, we invested in 3 biomass plants in the Philippines. Well, without that type of private and public sector coming together, we would never have been able to bring the private sector along, because the public sector was able to take some of those off-take risks, some of those risks that the private sector is not willing to do, and improving their risk return. A second area is in regulations and standardizations. Again, having regulatory certainty is a big part of what the private sector is looking for. We've got programs, for example, in the built environment on green buildings, helping define what a green building is, having standards for that, so the banks can come along. They don't have to reinvent the wheel. They can use those standards. And I think we had a lot of discussions about that earlier today again, of having standards, having definitions that people can take on. And then the third area, I think, is aggregation. A lot of these projects are very small. They're difficult for institutional investors to access. And so we need to find ways to aggregate. Again, at the I.F.C, where we have a $500 million rooftop facility in India. And the idea is that we have standard contracts for rooftop facilities, rooftop contracts, which we put in a line of credit for a warehouse. And once we have built that warehouse up, we can then securitize that and have access the capital markets and the institutional investors. So I'll stop there, but these are some of the ideas in terms of getting over those risks to bring more money into the markets.
Suzanne, you've been nodding your head a lot during these discussions, and risk. Let's just start with that. You're familiar with that, I suppose, as the head of the Green Bonds program at Bank of America Merrill Lynch. Actually, you're so familiar with it that, as I understand, one of your nicknames is the Green Queen, which I love. But maybe tell us, just do a little bit of a step back for us. And we've been hearing so much about green bonds today as a kind of a major instrument either holding promise, or as somebody on a recent panel just said, something that they're not interested in touching. Talk us through a little bit, sort of how far green bonds have come. What is the state of play today, and what are you looking at for the future?
Thank you. Sure. So green bonds are definitely all the rage today. I mean, you hear them being discussed regularly in the media, at conferences, on panels, et cetera. The market started in 2007. The very first green bond was issued by European Investment Bank, and I'm proud that Merrill Lynch helped in structuring that, coming up with this concept of using the proceeds of the bond for green projects. But for the next 6 years, the market was very niche. It was all smaller private placements, 5 million, maybe 50 million, predominantly AAA, supranationals, and other government agencies. And then we really started to see the market take off in 2013. We wrote the Green Bond Principles. We had some non-AAA issuers come to the marketplace. We started seeing benchmark-sized transactions, and then the market started to double and triple from there. So by 2013, I think we have maybe 13 billion total outstanding, and this year we're set to pass 150 billion total outstanding. So great upward trajectory in terms of growth, but light years away from the trillions we need per annum if we're only at 150 billion outstanding. And also, the green bonds that you're hearing about are what I like to think of as sort of a second order movement of capital. So it's bonds issued by well-known names that are already investment grade rated and are already regularly tapping the bond market. And the beauty of that is it makes them very accessible instruments for the end investor. They don't have to understand a new technology. They don't have to understand a new credit. It's just like a regular bond they would buy, but they know the proceeds are going to green projects. And that makes up the bulk of the 150 billion that's out there. I think there may be a bit of a misconception that green bonds are doing more than that, and that they're first order movement of capital, which is where we want to get to, where we're seeing money going directly into projects or directly into asset-backed securities securitized by green collateral. That's starting to happen, and we can give some examples of that, but it's only few and far between at the moment, and I think that's where we would like to be next, is really first order movement of capital in phase 2.
Well, given that sort of challenge, how do you think, where is the market going to go next? I mean, how do you get to that phase 2?
I think it's a lot of the things that Marcene was talking about. One is, first of all, having more of the projects already being done in the investment grade markets to date, the US, Europe, et cetera, coming and refinancing their already operating projects in the bond market. And we have seen this done a few times now. A lot of these transactions, once operating with a good offtake provider, are able to be rated at the low end of investment grade, BBB- from S&P, Moody's, Fitch, et cetera. And that enables the pension funds and the insurance companies and the infrastructure funds to come in and invest. But if you're going to now try to translate that one step further and bring it to the emerging markets, you need to find a way to get investors comfortable with the foreign exchange risk, and especially with the offtake risk, which may involve governments, which may involve regimes, different legal bodies, et cetera. So this is where we are looking for entities like I.F.C. to come in and do some kind of a de-risking mechanism to get the rating and the investment risk to a place where OECD investors are comfortable.
And I'd just like to jump in and say, I think that's a really important role that the MDBs can play in terms of de-risking and using donor money and using public money to leverage private sector money. But I also warn that the MDBs and the bilaterals, et cetera, were a small part of this total economic system, so a financial system. So for example, last year the MDBs did about $25 billion of that $350 billion, right? So there's a lot out there that needs to be done, that leverage, that's going to be outside the purview of the MDBs. And what I think is really needed here is we need to bring some of our best minds in the corporate communities, in the investment communities, in the commercial banking communities, in terms of real financial innovation that can unlock some of these things that will be sustainable over time. So that's the challenge to this audience, is how do we bring some of that real thinking in terms of new financial products, new ways of looking at it, new mechanisms that utilize the public sector, but really unlock the power and the innovation of the private sector.
And sort of, I just wanted to go back to something that Poppy had mentioned earlier as well, a little bit in line with this. You mentioned that I guess one of the challenges out there is that quite often the investor returns haven't been as great as one would have hoped. How do we sort of move past that and get to sort of the next phase where that actually is something that turns around?
Well, I think things are starting to turn around, and if I look at year-to-date performance, for example, of some of these sectors and parts of the market, they've really been outperforming world markets. So there is some, albeit a short period of data, some encouraging news. And when I look at the opportunity and the risks in some of these clean tech, renewables spheres, I actually think I'm very optimistic, frankly. And the reason is, when I look at a number of the risks, I think a number of the risks have diminished, and I think the opportunity is greater. So when I look at the risks, I think when you look at energy industry as a whole, energy is a heavily regulated industry, and regulation poses a significant risk to all investments across the whole energy chain. But what I've noticed over the last decade is that regulation certainly has got much more global. And so as a consequence, of course, companies and industries are exposed to regulatory risk, but the risk of any jurisdictional change has diminished in terms of its overall global impact. So let me give you an example of that. Post the global financial crisis, there were some changes in the Spanish regulatory regime around renewables. And frankly, Spain was such a big market at that time for renewables that in itself almost caused the whole wind industry to collapse. And if you fast forward to last year, and the UK made some regulatory changes on its renewable program, and the global industry didn't even notice. And in part, this is because the regulatory support, in part through Paris last year, but in part through many other mechanisms, has got much, much more global. And so your risks still exist, but they're a little bit more diminished and diversified, in my view. And I think then when you look at the competitive nature of this industry, it's also improved. And a number of other speakers have alluded to this, but when you look at the cost of solar, the cost of batteries, the cost of lighting, these are all technologies that have fallen in the order of 70 to 80% since the global financial crisis. I mean, this is huge cost deflation, which means that increasingly a lot of these technologies are cost competitive without subsidy, which again reduces your risks. If you've got a business that can stand on its own economic merit, and isn't subsidy dependent, I can only see that as a good thing. And the last thing, and I think it was the CEO of IKEA that was talking to it, is the technology. Like, these technologies used to be a little bit of a compromise. Like if you were to go, I'm not a car person, but if you were to buy an EV maybe 5 years ago, that may have seemed like a little bit of a product compromise. But now a lot of these products are equal, if not better, than the kind of incumbent product. So I think that technology change, you can say the same in lighting, that a technology change is also gives me cause for optimism as we look forward.
And if I may, Liz, just a couple of comments on what you guys have both said in terms of regulation and bringing the best minds together. To the Spanish regulatory risk, it's very interesting because in line with your idea of there's some hope, just this summer we were able to bring a bond to the institutional bond market that packaged together 40 solar farms in Spain and refinanced all of that bank balance sheet debt on institutional investor balance sheets. So there is kind of a forward movement that is starting to occur there post the regime change in terms of the feed-in tariffs in Spain. But I do think that regulation is one of the things that makes it harder to move forward, because regulation now is quite strict in terms of what bank capital is allowed to do and how much capital banks must hold and where they must price it. And so that's a bit of a challenge in terms of banks being able to move into newer territories, into new projects, into new risks. But to the point earlier of let's bring some of the best minds together, International Finance Corp, Bank of America, a number of French investors, some US investors, HSBC, and also Credit Agricole have all joined together, each pledging $1 billion of their bank's capital into something called the Catalytic Finance Initiative to very specifically look at how can we move the needle forward, how can we solve some of these de-risking problems, and how can we mobilize more investor dollars into resolving environmental and climate change issues.
So speaking of bringing some of the best minds together, let me actually open it up to the audience while we have a few minutes left, because I'm sure that there are some questions out there. Please raise your hand, and while we're waiting for you to think of some, there's a, yes, if we could bring the microphone over.
Hi, I'm Carlos Pascual with IHS. Earlier, Fatih raised the point that the fastest growth in coal is in Asia, particularly Southeast Asia and India. And a critical factor there is the rates of finance that are accessible to individual projects. Have you thought about mechanisms that could be brought together so that you can bring the cost of capital down in a way so that it becomes possible for Acciona or Enel to be able to be effective and profitable in that kind of environment?
Right. Well, yes, the World Bank has a new initiative in terms of follow the carbon. So it's very much along those lines of we only have a few years, 5 years or so, in order to start bringing this curve down in terms of carbon emissions. And so it's very important that we really focus and prioritize where we put our energy. And the idea of in Asia, the coal is a really important one, because we know that in 6 countries alone, if what's on the table in terms of building coal, we will sail past 2 degrees. So that's really important. I wouldn't be from the World Bank, and you asked me this question, I have to say the most important thing to that is putting a price on carbon. Putting a price on carbon in the energy sector is probably the most effective way in terms of making those projects more expensive and making the ability to bring in other technologies easier. And we know that with the Paris Accords, the NDCs, almost a half of the NDCs included a price on carbon. And while right now there's only about 13% of GHG emissions worldwide are covered by carbon prices, we know that 6 of the 10 largest economies are under carbon pricing. And so it is inevitable that those prices will grow, and that the economic sectors they cover will increase. So I think that's really going to be our key in terms of coal and in terms of the energy sector, is getting that price on carbon, and it is coming. So let's not wait till regulatory certainty, because we see it right around the corner.
Yes, please, over here.
Hello, I have a question about the mechanisms that you talked about to mitigate the risk in developing countries. Do you think those mechanisms are known by people who are actually having stakes in a project, like project holders, local investors? And if they're not known enough, how to make them more known?
Right. So I think there's a real gap in terms of us talking between the public sector and the private sector. So often, we think that these are public sector investments, these are public sector problems. But truthfully, the public sector does not have the financing capacity to bring the trillions to the table. So a lot of it is working between using very targeted public sector monies to leverage private sector innovation and private sector finance. And that's what we need to do. So we need to be better at talking to each other. We need to be better at working together. The private sector needs to be proactive, and we've seen a lot of great movement in terms of the private sector being proactive, pulling the public sector to the table and saying, you need to play a role, and if you play your role, we can do a whole lot more.
And also, sort of tying that question together with the earlier question about, getting more mobilization of dollars into India and to renewables, but also getting these structures and these entities to be better known. You had the large state-owned enterprise in India, that the utility, issue a green Masala Bond last month. What that does, and by Masala we mean it's denominated in Indian rupee, but actually denominated in dollars, but tied to Indian rupee. So that does two things. One, it gets the institutional investor market globally familiar with the state-owned utility in India's credit, and it also starts mobilizing the exchange market in Indian rupee in large amounts, so that should you ever want to do a solar project bond from India where the offtake provider is that state-owned utility, you've already created a couple of the stepstones. You've helped to create a better flowing market in the Indian rupee exchange rates, and you've also gotten the investors to at least have taken one look at who that state-owned entity is as a credit, so that they may be more comfortable taking that offtake risk in project bond format.
Poppy.
And I'll just
last
add
word.
one thing on risk, because I think risk and information is something that really helps investors allocate capital. And if you can understand those risks, then it makes it much more easy to invest. Risk is not necessarily bad, we just need to understand it and price it correctly. And so at Blackrock, one of the things that we're trying to do around climate and carbon is really that piece. So now across all of our portfolios, and all of the assets we own across the world, we can completely map their carbon footprints, their environmental footprints. We can look at this at an issuer level, at a portfolio level. We can give clients an understanding of their exposure and their risks, and we can track that over time. And there's some evidence, although the timeframes are quite limited, the data set is quite limited, that where we do see improvements in sort of performance on some of those metrics, it has led to improved returns. So I think that risk and information piece is important, and there is space and still room for improved disclosure at a corporate level, and to really drive through disclosure and information that is comparable across companies, across industries, and that is certainly something we're working with also with other groups to try and find some solutions and improvements there.
Great. Well, thank you all so much for being with us today and for taking the time to talk about this. We're actually going to continue a discussion of capital flows with our next panel. So I'll welcome up my colleague, Katrin Benhold, to introduce them. Thank you.